The deals keep coming in artificial intelligence. Amazon, OpenAI, Microsoft, all poised to raise or spend billions of dollars to boost processing capacity. We also got, generally speaking, a week of better than expected earnings from the internet giants. We're joined by Tom Bruce. Tom Bruce, macro investment strategist at Tanglewood Total Wealth Management. Tom, thanks very much. When you look at this flood of deals in AI, billions of dollars involved, maybe all these data centers won't ultimately be built. But what's your impression? What jumps out for you?
Hi, thank you for having me. So overall, all this investment going into AI is very positive on the real economy. But bigger picture for investors, it's where we're at currently. A lot of the things need to go right now for this AI investment to really pay off. I think I'm a believer in it. I really think it's going to change the world. But at the same time, I think it's both the biggest risk and the biggest opportunity for the markets in a sense that, we may be looking at the very beginnings of a bubble in AI. But, at the same time, there's also a lot of opportunity. If everything goes right, then there's still tremendous upside.
Right. So I think your view broadly is it's not yet a bubble, but signs are emerging, including the circular nature of some AI deals. For example, NVIDIA investing in an AI company as long as they buy NVIDIA chips.
That's right. I think the circularity deals are seeing that kind of feedback loop. Again, more needs to go right for the valuations to hold up where they're at. I also think if you look at other areas like quantum, if you look at nuclear, we've seen huge gains this year in those industry stocks, and not a lot has changed for many of those companies. So there's certainly signs of irrational exuberance taking place on the market. Not a big deal at this point, I think. But if you look at the broader economy, we have a lot of stimulus going on from the government. We have a Fed that's been cutting. Those are very bullish for the market. So you have this kind of recipe setting up where you could, see a bubble emerge, thanks in part to looser monetary policy.
Maybe we could put up a one-year chart for a couple of the uranium stocks, say CCO, Cameco, the big miner. I mean, without necessarily commenting on that company and maybe some of the big electricity generators like Constellation Energy, without necessarily commenting on those companies, these plants will presumably take years and billions of dollars to build.
Exactly right. It's pretty far on the horizon where you see some of these plants materialize. And for investors, if one little thing goes wrong, if it gets pushed out further, if you see another entrant in the marketplace, DeepSeek, for example, if they were to produce a better model, and the Chinese ecosystem is the one that really leads the way, that would be problematic for U.S. markets, to say the least, because so much has been invested in the U.S. markets for the AI ecosystem here.
Oh, you think that Chinese AI technology could ultimately pose a significant challenge?
There's a potential for that. In the day, I think the U.S. AI will win in a sense. I think we have the best engineers in the world here. But at the same time, that's a risk that can't be dismissed because so many U.S. companies and Western companies in general are invested into this U.S. AI theme. So if we have something emerge out of China that rivals it, that could be a big problem.
I know some economists argue that government deficits are really just a product of economic activity. When the economy's weak, governments tend to run deficits, and when they boom, the opposite happens, or deficits come down. So you see that possibility that the U.S. will achieve sufficient productivity and economic growth to really make the massive government debt burden less of a concern?
I do. I think that's the hope of a lot. That we've already tried with Doge to cut deficits, and it didn't really happen. So at this point, we're only really left with the option of growing our way out of it. So there's a combination of increased productivity from AI, which I'm a believer in it. I think the investment theme is more debatable, but I really think AI is going to change the world, and it's going to raise productivity in such a way that it could really help pay off the debts, or not pay them off, but make their debts more sustainable in the U.S. That combined with a little bit higher inflation, gets nominal GDP to a point where this becomes a lot more sustainable. I'm more optimistic in what we could potentially achieve here in the U.S. and many other Western nations that have substantial debts.
Could we turn to the Fed? Do you think they are going to be forced to go on cutting?
Well, it's hard to say. The way that Jerome Powell came out at the last FOMC meeting and made it a point of mentioning that December is not a foregone conclusion, that gave me some pause because he really wanted to make that point, and he didn't need to. But in my point of view, it looks like he may be placing the odds on no cut for December. And if you look at the market odds for that, it's still priced pretty well for a December cut. I think it was about 65% last I checked. And if you look at December of 2026, so the end of next year, hasn't changed a whole lot. So, the market may be reading this wrong here. We have some signs that employment stabilized. We don't have a lot of data right now, but we have some signs that employment stabilized in the U.S., and we have some signs that inflation is ticking up. So both of those go against further rate cuts. So I'd say that's certainly a risk going forward, is that the Fed's less stimulative than many expect at this point.
Tom, thank you very much for joining us today.
Thank you for having me.
Tom Bruce, macro investment strategist at Tanglewood Total Wealth Management.